Hello everyone. Today I'm going to talk about one of the biggest names in the business, Google. This video is extremely important from investment point of view as it will also give you insight of other magnificent 7 businesses. Today Google is standing at a juncture where it is the most profitable company in the US and second in the world. It is investing heavily in the future technology such as AI, quantum computing, FSD cars and cloud. It is sitting on a huge cash pile, and despite all these, it is trading at a valuation which is closer to market average, much lower than its industry peers. And that's why I call it curious case of Google. It is at a very interesting turning point because from here it can either give you multifold returns or it can just become a value trap, and therefore understanding the risk becomes very crucial. But risk has many layers, so let's unfold one by one. So let's start by scratching the surface. If you look at this revenue chart, Amazon is leading the pack with highest sales, followed by Apple and Google. The most expensive stocks over here, Nvidia and Tesla, they are sitting at the bottom. While revenue does not reveal much about company's profitability, it does show how fast a company is growing in terms of sales growth. Now, this is the net income chart and it shows the profitability of the company. Here we can see that Google is the most profitable company with $111 billion in profit. It is followed by Apple and Microsoft. It is also far ahead of Amazon, which has the highest revenue. From these two charts, we can interpret that Amazon has a very high operating expenses. Now, what is operating expense? It is an expense incurs by the business through its normal business operation. In terms of cash reserve also, Google is sitting on a huge pile of cash just behind Amazon. In terms of free cash flow, Google yet again is just behind Apple. Free cash flow signals company's ability to pay debt and dividend, repurchase shares, and contribute to the business growth. So until now, Google seems quite a good proposition, considering the sales and profitability. Now let's look at price to earning ratio, because this is where it gets interesting. Price to earning ratio shows the premium investors are willing to pay for the profit company generates. And from this chart you can see that Tesla is commanding the highest premium while Google has the least premium. So does it mean that Tesla is overvalued and you should not buy it and Google is very cheap and it is a very good buying opportunity? No, it's not that straightforward, because there are many other matrices which needs attention in order to price in a stock. Having said that, it is very common for growth companies to have high P by E ratio because investors pay premium due to future growth expectations. So at this point, you should have a very valid question. Whether market does not believe that Google is going to grow at par with other Magnificent 7? Yes, that's the narrative out there. But it could be wrong also. It is possible that Google is undervalued and is a good buying opportunity right now. So let's dig deeper to find out. Now let's look at price to sales ratio. Price to sale ratio is how much investors are willing to pay for every dollar in sales. And here, my friend, we can see a beautiful valuation anomaly. Even though investors are paying much higher premium for every dollar of profit in Tesla, they are paying almost same as Meta when it comes to every dollar of sales. Meta is generating huge profits today. So it could mean that market is not pricing in Meta for future growth. It may be undervalued. Or it could also mean that Tesla is ridiculously overvalued. And this is the risk you need to know before you invest. Of course, there are macroeconomic factors which will help you to see the trend. Then, being aware of geopolitical situation helps you to identify sectors which may be good or bad in short to mid term. And all these things helps to price in the stock. Now, let's look under the hood to understand why Google is not commanding high premium like its peers. Is it really undervalued or just a value trap? This is a CapEx chart. CapEx is investment in the future. It's what a company spends today to grow or maintain its operation for tomorrow. And here we can see that Google has the highest CapEx after Amazon and Microsoft. Next, let's see research and development expenses. And here again, Google has highest expenditure on research and development after Amazon. So Google's capex and R&D is quite high when compared to Nvidia. It is even ahead of Meta. So on surface level, it seems Google is spending much more on innovation when compared to Nvidia and Meta, and yet we see that Nvidia is commanding much higher premium than Google. To understand this contrast, we need to see the operating margin. So here we can see that Nvidia is exceptionally efficient. It earns nearly half of the revenue as operating profit. Google is far behind Nvidia and even Microsoft and Meta. But Google is positioned far better compared to Tesla, Apple, and Amazon when it comes to innovation and efficiency. Now let's shift our focus to forecast. Here we are seeing the estimated earnings per share for 2026, and Google stands third after Meta and Microsoft. In terms of estimated revenue also, Google is just after Amazon and Apple, which indicates a solid sales growth. Google is expected to grow from its current $359 billion to $430 billion, close to 20% increase. It shows Google's top line growth is still solid, even as a large company. Google is expected to generate strong bottom line profit despite its high investment. Note that although estimated revenue growth of Google almost same as Apple in 2026, its current operating margin is better than Apple. Its revenue is less than Amazon and Apple, and it is more profitable and less in valuation. In terms of growth in profitability, Google has outperformed Tesla, Apple, and Microsoft. So basically, in terms of growth in profitability, expenditure in innovation, and estimated earnings and revenue, Google is very well positioned among Magnificent Seven. And yet, its valuation is very low. You must be wondering why the market is not pricing Google's valuation fairly. Let's try to solve the puzzle by decoding the business and the narrative. This is a breakdown of Google's revenue, and you can see that 87% of the revenue comes from Google services, 12% from the cloud, and 1% from rest of the other bets. So there's narrative in the market which is centered around premise of decline in Google search due to advancement in the AI. Ironically, despite of Google being leader in AI, it is seen as playing catch up to Microsoft and other Magnificent Seven in terms of AI, and having more to lose than to gain from AI replacing the traditional search. See, Google's core search segment continue to show solid growth despite concerns about competition from AI tools. And I'm not going to say much on this. You think yourself, have you stopped using Google services? Google is very well integrating AI into its search engine and all other services, and I think it is very well positioned to leverage AI into its ad businesses. The other narrative which is being spoken in the market is Google's too much dependencies on ad revenue. See, Google is already diversifying its business. 12% of its revenue is coming from Google Cloud, and Google Cloud has recently become profitable. It is scaling its driverless car business, and it is also investing in quantum computing. But I think that ad business is Google's core strength, not liability. Global digital ad spend is expected to grow 10% annually over the next 5 years. And I think that Google is best positioned to capture this growth due to its global reach. And by the way, Google runs a very high margin ad businesses in the world. So if I had to bet on one ad platform for the next decade, I think it should be Google. You should also know that there's an antitrust lawsuit which is filed against Google, and do your own analysis, but I think that antitrust risk is overstated and already priced in. Uh, and this is not new for Google. Google has already faced regulatory scrutiny for over a decade, but their business has remained unimpacted. And not just Google, tech giants like Meta and Microsoft has also faced legal scrutiny in the past, and it has grown regardless of that. So the point is that such kind of events are already priced in, and they don't have much of an impact in the valuation. Last but not the least, each Magnificent Seven companies has some kind of story attached to it. For example, Microsoft has AI, Meta has Metaverse. Amazon has cloud and e-commerce. Nvidia has chip design and Tesla has EV. What's missing with the Google is a hot story despite solid execution. To summarize, the narrative around Google business does not sync with the numbers. In my opinion, it is an undervalued stock and present a good buying opportunity. Please note, it is not an investment advice. So do your own research before investing. And thank you for watching.